Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Bob Long, CEO of StepStone Private Wealth. Bob, thank you for joining us here on the program today.
My pleasure. Excited to be back.
Yeah, this is, I think, our third time together.
It is.
So I'm really excited to dive in, and we're going to talk about private credit today.
Perfect.
So private credit has really grown in the wealth management channels. I think some clients on average now have about 6% exposure to private credit. There's also been a lot of news in the private credit space, so we're going to have a lot to cover today. What are you and your firm currently saying about the private credit environment?
Great. Well, let's put that in perspective to start. So we are one of, if not the largest allocators to private credit globally, committing over $11 billion a year to that space. And we are primarily a co-investor. So we're sourcing from about 100 different loan sourcing partners. So we see a tremendous amount. And in terms of what we're seeing today, a couple of things. First of all, spreads have clearly compressed as compared to, say, 2024. On the other hand, base rates have declined, which has allowed interest coverage ratios, a key indicator of the health of borrowers, to increase. There is some pressure on covenants, meaning in favor of borrowers against lenders, but that's occurring primarily at the upper end of the market. And we find in our portfolios, we've been able to maintain discipline and not provide a lot of loans that are pay in kind. That's a headline we've heard about. Maybe we should explain. Pay in kind means the borrower is paying with paper, not with cash. And as borrowers gain strength in the negotiation tug and war, you may see more of that. We, however, see less of that in the middle market, and particularly in the portfolios that we're constructing for clients.
What I've learned in all asset classes, what's really important is diversification.
Yes.
So are your portfolios diversified?
Well, I feel like that's a plant, Marianne. I got to tell you, in credit, diversification is incredibly important. So if you think about the benefit of concentration in, say, a venture capital portfolio, which we have a venture fund for individual investors, it's called Spring, and we have meaningfully sized positions that with companies we have a lot of conviction around, like SpaceX, for example. On the other hand, in credit, it's the opposite. In credit, your upside is getting your money back. So diversification is your friend, and there's really no benefit to concentration. And you've seen some headlines around large positions in certain large, well-known credit funds that have suffered write-downs or been put into some sort of, write-downs. I don't think you've necessarily had defaults or losses yet, but write-downs. And in many cases, those large funds had 2, 3, 4% of their portfolios in one loan. And we would really encourage individual investors and financial advisors to focus on that. In credit, diversification is your friend.
So it's important for any advisor or client that's looking to invest in the private markets, you got to know what you own. You got to know what the private credit fund is investing in.
You know, even since you and I started having these conversations now 2 years ago, the market has gotten so much more thoughtful and sophisticated, and financial advisors have gotten educated, which we view as a very positive thing. But so within private credit, you have certain well-known large funds that tend to concentrate on very large borrowers within the context of direct lending. And they take the position that those larger borrowers are by definition less risky. And it's certainly true that if that's the only dial you're turning, if that's the only metric upon which you're making a comparison, that a bigger company has less risk than a smaller company. But what's not often expressed or understood is, in many cases, those larger borrowers are taking on more leverage, and in many cases, they have the ability to negotiate looser to no covenants, and therefore lender protections are less. So sure, it's great. There are benefits to lending to a larger company, but often you need to understand that there are also negatives associated with weaker structures.
Well, it's kind of ironic because we're filming here during the holiday season.
We are.
And I'm going to pivot to what's called evergreen funds, which I always feel is a Christmas tree. And evergreens are become very popular. They're also in the news. Can you please explain what an evergreen fund is and what's all the buzz about an evergreen fund?
Well, I can, but I guess we just approach life differently. When I think about evergreen funds, I think about the Barbra Streisand, Chris Christopherson song, and how everyone probably thinks we look just like them. But any of that,
I'll take that.
I'll take it too. I'll take it too. So evergreen funds. So it's like a mutual fund in that when you invest, you're coming into an existing portfolio, generally highly diversified. So like when you come into a mutual fund overnight, you invest in those existing assets. You don't have unpredictable capital calls and distributions the way you have in a drawdown private markets fund. Right? So you put all your money in at once, and the fund manager is responsible to keep that money invested. You get regular indications of value in many of our funds daily and our venture fund monthly, as opposed to waiting to quarter end and well beyond quarter end in the case of a typical private markets drawdown fund. The minimums are low. They're not quite as low as a public securities mutual fund, but they'll be quite low, quite reasonable, $10,000 in many examples. And then you get a 1099, not the dreaded K1. So they have many of the convenience features of a mutual fund. So an evergreen private market fund is different from a mutual fund in that you can't get liquidity every day. Industry standard is quarterly liquidity for 5% of the fund. And that's important, by the way. 5% of the fund, not of your investment. That's an important difference.
So evergreens are very popular in the credit space. Is that why they've become popular? Because you don't have to lock up your money the old traditional way for like 7 or 10 years and you didn't have a lot of liquidity, that these are new vehicles that are giving more liquidity to clients, yet they're getting the exposure to the private market.
Yes, but there's also another important reason. The benefits so evergreen funds aren't for everything, every asset class, and we should probably talk about that. But if you think about private credit, you generally invest in private credit or any credit to get steady income and have ballast in your portfolio that limits volatility. Well, with the drawdown fund for private credit, with the back and forth you have, that's sort of against the purpose of private credit. So when we think about evergreen funds and the asset classes that fit best, or maybe to say differently, where an evergreen fund creates the most advantage for an investor, private credit would be the poster child. It would be first and foremost. Now, if I could take the implication of your question, though, it's not ideal for all asset classes. So to run an evergreen fund, you have to constantly feed the beast. You have to constantly have a steady stream of assets as the manager to put into the fund. So distressed debt, for example, something that's particularly cyclical, is not a great asset class to package in an evergreen fund, in our opinion.
You've been a leader in the evergreen funds, and I think you've been doing this about 20 years, not trying to date you. What is one of your pro tips on evaluating evergreen funds?
The single most important question a financial advisor or an investor can ask about an evergreen fund is the allocation of deals policy. In other words, when the investment manager, like StepStone, sources an investment, how does it get allocated among its various clients, its various constituencies? And what we follow is a pro rata allocation policy, or said in layman's terms, same deals, same price, same time. And I would say that is the single most important question. If you're a Sanctuary client, your financial advisor is already picking from a highly curated list of high quality funds. And so the funds are institutional caliber. Just make sure you know that you're getting the same deals at the same price at the same time. That's my pro tip.
What I think is also important for you to talk about, and we didn't talk about this and I don't want to embarrass you, but you have quite a track record professionally.
Some people say I just can't keep a job.
That's actually really funny. I think you actually worked at Bank of America.
I did.
Why don't you talk about the executives that you have that founded StepStone and who's really running StepStone? Because your backgrounds are quite extensive.
Well, thank you for asking that. So I'm joined by 3 other co-founders of the private wealth business at StepStone Private Wealth Solutions. And we came together about 6 years ago with the idea that we would try to create, and I think we've been successful, the most investor-centric firm in the retail alternative space. We were committed to two principles. The first one is one I've already mentioned, that same deal, same price, same time. That our individual investor clients would never be adversely selected in favor of the institutional clients. And the second principle was to try to be the most investor-centric, which is a little bit like mother's milk and apple pie, right? But we drove down on that. And what we seek to do is to be the most convenient, easy to do business, efficient, fairly priced, and transparent, no surprises. If you look at these products historically, in terms of retail access to private markets, is a 3.0 or a 4.0. It's quite different than the early non-traded REITs and non-traded BDCs, which were not institutional caliber in all cases, had very high upfront fees, and were not particularly transparent. So what we've done is brought those institutional characteristics to the individual investor market. And my three co-founders and I come from very different backgrounds. I had primarily an institutional background. My partner, Tom Sidema, had led real estate for Bank of America and then was the head of another large platform called CNL. His head of sales, Neil Menard, we believe is the best in the business, and in a business where sales is really important, and clearly the most institutional in his approach. And then our fourth co-founder is Tim Smith. Tim and I did Conversus Capital together, the largest listed fund of funds, and he is a master of all things operational and financial. And in a firm where we do things like daily valuation of private assets, that's incredibly important. I would say if you met all of us, you were four very, very different people, but we've been able to harness our differences and our strengths to work together to create a business we're quite proud of at this stage.
So you have diversification.
We do have diversification.
We know diversification works, and I just want to reiterate what you've created is a transparent and authentic platform for private investors to be able to invest in private credit, or at least that's how I view it.
Well, thank you. That's quite a compliment.
Something that we didn't talk about, but we have talked about before, and I just want to bring it up because there's a lot of buzz about it.
Yep.
Artificial intelligence, AI, data centers. Everybody's super focused on that. You've been leaders. You have products that have invested in that. Why don't you talk a little bit about that? Comes under infrastructure. Why don't you talk a little bit about infrastructure?
Yeah, I think private credit has clearly captured a lot of the attention of the market and the press for the last handful of years. I think a year from now, people will be talking even more about private infrastructure. So outside the U.S., private capital to invest in or create essential services is not a new thing, but it's newer for U.S. investors and U.S. financial advisors. But I think we'll be talking much more about it really for two reasons. First of all, there's a huge hole. Our research says about $3.9 trillion a year in capital need. And so that's an opportunity for individual investors to fill. Secondly, and you're an investment strategist, so you know this, but important for our audience to understand, private infrastructure has less correlation to other institutional asset classes than any of the other traditional asset classes. I won't speak to crypto. I don't know anything about that, but of the things that you recommend and have studied for your career, private infrastructure has less correlation. And it also has very meaningful inflation protection because typically the underlying contracts, let's take the toll road. Outside my office in Charlotte, there's a privately owned toll road. That toll road contract has a CPI inflator built into it. In other words, as the consumer price index increases year over year, tolls automatically increase. So it has a high degree of inflation protection. And I think that's another reason why investors and financial advisors will be talking extensively about private credit over the next couple of years.
So it's not too late to invest in infrastructure.
No, I really don't. I think we're at the beginning of a cycle. And I talked about infrastructure broadly, but let me go deeper on AI. I'm a skeptic by nature. I do definitely look for what's wrong. And I've asked myself, these AI companies, we own a number of them in Spring, our venture fund available to individual investors. And without speaking to any of them specifically, the research I've done indicates that, yes, the valuations have moved up. Well, that's not research. That's just a fact. Valuations have moved up quickly, On the other hand, the revenue of these companies has grown. These are companies that have been in business 2 years and have $1 billion or more of revenue. And according to the work we've done, if you look at their revenue trajectory versus, say, the early tech titans of a Google or a Meta, you know, they actually compare equally or favorably in terms of valuation to revenue. So I think there's a long way to go. I do think AI is the next great inflection point in human development, not just investing.
So not a bubble yet. Early stages.
I don't know if I'd say early stages, but I'm confident in saying, my personal opinion, that we're not at a bubble. There's a lot of room to run. There are numerous companies that can be trillion-dollar companies in this space. We seek to identify them and gain exposure to them through Spring, but I think it is, look at it this way. When a 64-year-old recovered lawyer can't live without this tool, and it is making me more efficient every day, I think that tells you something.
It says a lot, definitely.
In my opinion.
A lot. There have been concerns in the private credit market. It seems to be more fraud than real credit issues. Yep. Are there any other issues that investors should be worried about in the private credit world?
Good question. We believe private credit offers a very attractive risk reward, but of course, with any asset class at any point in time, there are considerations investors should be focused on. So let's start with what's going well. In the middle market, we see companies continuing to grow revenue and EBITDA. So that's a good thing. That makes their credit stronger. We see very little of this pay in kind we talked about in the middle market. We have not seen a lot of defaults, and we have not seen a lot of assets go on watch list. But things to be concerned about. Oh, one other thing. Rates were there was a rate cut yesterday. So that cuts base rates, and the return to private credit investors is based on the base rate plus the spread, and there's typically leverage involved, and then net of fees. Well, when base rates go down, that generally decreases the overall nominal return. Now, historically, as base rates have declined, spreads have been able to offset some of that and benefit investors. So we'll see how that plays out after yesterday's rate cut. I can't predict the future. But in terms of the considerations, at the upper end of the market, I think we touched on this, there is pressure on covenants. We've not seen a lot of exits in private equity. And so there's not been a lot of supply, or as much supply as we like to see, of private credit or new loans. So that does give borrowers a bit of negotiating leverage, particularly at the upper end of the market. Second, this pay in kind. There are certain funds that have meaningful exposure to pay in kind loans that I would encourage investors to pay attention to that. But net, these headlines you've seen, there have been a couple of examples of fraud, which are just mistakes in underwriting. And there have been some really good things written for those who will go find them about how there were obvious red flags around those loans. And perhaps the lender
should do your homework.
Should have seen that coming. And a number of the other headlines have not been direct lending, not been the privately negotiated things we do and that you typically have talked about on this show, but they've been broadly syndicated loans or bank syndicated loans, which is a completely different kettle of fish. Those are not banks generally being principal lenders, and that creates the principal agency problem that private credit helps overcome.
What are some of the other opportunities you see, right? Obviously, we talked about infrastructure and AI. What are some of the other opportunities you're seeing out there?
We believe the private equity secondaries market still offers really attractive value. Yes, that market has grown in a material amount, but you really need to think about secondary trading as a derivative or fraction of the primary market. You know, before there was a secondary market in private equity, it was sort of a market where you could only buy on the IPO. You know, you could only go in at the beginning. So as private equity has matured, you've seen an increasingly large, diversified, and sophisticated secondary market. Now, second to that, infrastructure secondaries. Infrastructure is on a similar growth curve as a basic private markets business to where private equity was 10 or 20 years ago. And now we've seen a secondary market in infrastructure grow up, and we think there's some really interesting opportunities. Now, the discounts, you might see on average a 20% discount in private equity secondaries for a limited partnership interest. Those discounts will generally be lower in infrastructure because it's a lower risk, lower return asset class in general. But when you can achieve interesting levels of discount around an asset that has the CPI indicator or the inflation protection in it, It is investing in essential services like toll roads, bridges, power generation, those sorts of things. We think that's pretty interesting. So that would be my choice.
Those are really interesting. There was recent news about Apollo, which is a publicly traded private credit firm.
Yeah.
And they were talking about, or at least if I was reading this correctly, creating a trading platform for private credit. Now, there is secondaries. This sounds to me like a secondary market, but a special kind of secondary market. And the way I look at secondaries, it provides liquidity to the environment and to investors. I don't know if you've had an opportunity to look at that announcement, and what would be your view on what you think Apollo is trying to create?
Well, I've just read the announcement and I haven't studied it, so this is based on just what I've read like you. Net, it appears that Apollo is trying to create a trading desk or a secondary market for individual loans. And they have the capital to do that, apparently from some insurance company balance sheets that they're affiliated with, or at least that's what I understand. And I'm sure it will start small and then grow from there if it's successful. But I do believe from the individual investor perspective that creating more liquidity, more price transparency around private assets is a good thing. And it will ultimately lead to more capital formation, which is a positive thing for the economy.
Yeah, to me, that's also another sign of the growing part of the asset class.
Yes.
It's important. It's part of the growth in the asset class.
Yes.
Let's pivot a little bit and let's talk about venture capital. You kind of brought it up
Sure.
in the beginning. Of course, I heard SpaceX, and that caught my attention because they've announced that they might list going public next year. What's all this attention on venture capital? The way I grew up, venture capital was the riskier part. If you were looking at all different assets to invest in, venture seems to be one of the riskiest, but with risk comes reward. So what are you seeing in venture?
Well, first of all, let me address your point about risk. That's absolutely true. Venture does tend to have the highest risk and highest reward opportunity of the private market asset classes. But when we think about venture for individual investors in the fund we've created and offer on your platform called Spring, it invests in later stage companies. And in fact, it's about 70% venture capital, late stage venture, and about 30% growth equity. And so these are not garage startups. These are not early stage. We do that for institutional investors. We just don't think it's the right thing to put in an evergreen fund for individual investors. So on average, those companies in Spring have 50 million or more of revenue. Like, these are real companies. You've got the does it work stage? Is there a customer stage? Can we gain sales traction? These companies are generally in the can management execute on the growth plan. And that's where we like to invest. And that's why the risk, the return opportunity is not the same as it would be an early stage, but the risk profile we also believe is smaller. So that's what we offer, and it's a quite diversified portfolio of 1,500 companies.
Oh, that's a lot.
SpaceX is included in that, along with a number of other high-profile companies we've talked about here today and that you read about in the press. So for individual investors, we do believe that some access or some exposure to venture makes sense. We live in a world where this is a big change since when you and I grow up, I think. We live in a winner-take-most world where a small amount of competitive advantage can be leveraged globally quickly. Like, who knows who the second best Excel competitor is? Yeah.
Well, there used to be one.
Yeah, well, we remember Symphony and Lotus.
Lotus 1, 2, 3.
Right.
There's also something called Quattro Pro.
Okay, now you're ahead of me.
Well, I worked for a technology analyst. We beta tested a lot of things.
Yes. But today, we live in a winner-take-most world, and so a small amount of advantage can be quickly leveraged if it's software globally, unless there are regulatory barriers or burdens. That can be global very quickly. And so venture is at an interesting time. And when you think about the benefits of AI and the way AI allows a company to develop code, historically, we lived in a world where individuals drove the creation of code. But today, we're rapidly getting to a point where you tell the machine to solve the problem, and it goes and solves it for you, as opposed to you having to direct the machine at every step of the way. So the innovation opportunities, the productivity opportunities, and ultimately the wealth for the economy opportunities that creates, I think, are pretty meaningful.
What's really interesting is we had the Fed meeting yesterday, and one of the things that Chair Powell talked about in the news briefing was productivity.
Right.
And you don't hear a Fed chair talk about productivity that often, but it looks like the Fed in the economic projections are now starting to factor in higher productivity.
That would be a great thing for the economy.
That also helps inflation. So and it helps
Right.
growth. So it's kind of a
to be
balancing
clear,
act.
it helps keep inflation down.
That's correct.
And that also would be a good thing.
So maybe that's a positive, and that's going to lead me into my next question. So here we're coming to the end of 2025.
Yep.
It's been a great year, and I'm sure you and your partners have had to sit down and kind of map out the environment for 2026.
Right.
What are some of the things that you're looking forward to or seeing in the upcoming year of 2026?
We really do. And in fact, I think we were at an inflection point this year, and that demand curve may actually take a step up. Everything we're hearing from our wealth management platforms, from Sanctuary and from the many others that we work with around the world, is increasing interest in gaining access to the innovation economy through, for example, a venture fund, private equity secondaries, taking advantage of that opportunity, infrastructure, and of course, private credit, which we talked about. So net, I actually expect next year to see substantially enhanced flows into our evergreen funds, and we're excited about that opportunity.
So one of the things we didn't talk about, and so I don't know what the answer is going to be, because I may not get an answer, but blockchain, the investment in blockchain, which is a technology that people are programming on, it's a technology that crypto is on. Are you seeing any investments in that form of technology, whether it be crypto or blockchain?
We're seeing a substantial number of investments in blockchain technology and trying to apply that in different aspects of the financial services business. So back to your productivity point, as that goes from experimentation to implementation, I think it can have an impact on productivity. It affects things like security, like transparency, all of which are really important in a global financial services world.
It also, I believe, lowers cost.
Apparently, once fully implemented, it can lower cost and lower the frictional or transaction cost, which is really just a tax on the system overall, and that also is a good thing.
And one of the things that I'm hearing that maybe some viewers might be surprised is eventually Wall Street will be trading on the blockchain.
I've heard that too. That's beyond my pay grade to fully understand how that works, but I've also read that.
I've also heard real estate might trade on the blockchain. Harder to do, but definitely we're in an innovative period that we're probably going to see over the coming years. We're going to continue to constantly innovate.
100%. I mean, things like the daily valuation we offer on 3 of our funds was hard to imagine you could do that 3 years ago. And yet here we are doing it on about $10 billion of assets every day.
So Bob, not to date you, but you've been in the industry a few decades.
I have.
Maybe 40.
Maybe 40.
What are some of your best investment ideas?
Well, I'm going to give you an off-the-run answer, a non-financial answer. It takes $25,000 to $35,000 for a family to adopt a child in the United States. So you have thousands of families that are ready, willing, and able, have raised most of the money they need to adopt, and a child who is available and is without a home, without a family. And so I support a charity called Gift of Adoption. And for our average grant of $5,000, you can complete a family. You can provide that last mile. And the way I look at that, families are forever, and that is an infinite return.
Ooh, I got the chills. That is absolutely beautiful. And I have friends that have adopted, and it really is a very beautiful thing. So
it is. I'm adopted, as many people know, and adoption is one of those. Part of the reason I'm so interested in it. So much divides us today. We seem to find the ability to fight red and blue on so many things, but adoption is a cause that really has no enemies, and it tends to bring us together. So it's what my wife and I have really chosen to focus on from a philanthropic perspective.
That's absolutely beautiful.
Absolutely
beautiful. We've covered a lot here in our discussion today. So my last question to you is, what haven't we talked about that you think is important for our listeners and viewers to know?
let me go back to basics. One thing we didn't talk about that really underlies our whole conversation is the importance of individual investors considering an allocation to private markets within their portfolio. Many studies have shown that individual investors can enhance their return potential and their downside protection potential by including a moderate allocation to professionally managed private assets, whether that's from our firm or one of the many others that you offer.
No, that's
but
true.
I really believe we're in a world today where the vast majority of individual investors who have meaningful net worth should be considering an allocation to a professionally managed, highly diversified private markets fund. Typically, the entry point there is an evergreen fund. For some larger investors, drawdown funds make sense. But going into next year, you're going to see some of those that have been slow to adopt get on the bandwagon and start making meaningful allocations to private market evergreen funds.
Yeah, I have to say, based on the people that I talk to and the research that I do, is that you will continue to see portfolios be diversified. Now, private markets are called alternatives, and there's many other things that gold and commodities are also called alternatives, that there definitely is a trend in adding the private markets to a portfolio, and we have seen a positive impact in terms of return and risk profile.
And financial advisors that aren't at least talking to their clients about it need to understand the competitors are. And so at a minimum, it needs to be in the dialogue, in our opinion.
That's a very sage advice, Bob.
Thank you.
Bob, I always learn something when we have a conversation, and I want to thank you for being on our program today.
My pleasure.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.